Hello and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we've been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on or by following hashtag QC Weekly Comment on LinkedIn. I'm Jack Bishop, investment manager based out of our Manchester office, and this week I'm pleased to be joined by Richard Carter, our head of fixed interest research, and Will Howlett, one of our global equity research analysts covering the financial sectors. Good morning to you both. I don't want to turn this into an episode of The Rest is Politics, but there is quite a lot of news flow around politics at the moment. Obviously, here in the UK, we're fast approaching the general election. In the US last week, we had the latest presidential debate between Biden and Trump. And then in France, over the weekend, we had the first round of voting following Macron's surprise snap election. So we're into the tail end, really, of the campaign in the UK. It was almost a non-event in comparison to what we saw towards the end of last week in the US. So the debate between Biden and Trump, Biden's frailty was quite apparent, and it was generally taken to be quite a poor performance and has become a major concern for the Democrats. Had been calls for him to step aside, perhaps making way for someone that could compete with Trump more effectively. But then over the weekend, we've had heavyweights, including Barack Obama and Nancy Pelosi, come out in defense of Biden, defending the performance during the debate and his term as president. And then turning our attention back to Europe in France, the first round of voting concluded on Sunday, and the right-wing RN, led by Marine Le Pen and Jordan Bardella, secured around a third of the vote, which then followed by the left-wing coalition on around 28%, and then Macron's more centrist grouping securing 22% of the vote. So French equity markets rebounded a little bit this morning, as it seems the RN are probably unlikely to secure an outright majority, and the NPF and Ensemble Alliance already discussing potentially standing down candidates if there is a three-way split. So Richard, firstly on Biden, what do you make of the whole situation? So Biden's presidency, again, depending on your political views, and generally speaking, the economics of it has been impressive, record job growth, fiscal packages passed and inflation brought under control. Doesn't seem to translate to voters, though. And with the performance of the debate last week, do you think another candidate is needed to turn this around for the Democrats, particularly in swing states?
I must say, Jack, watching some clips of the debate, how they've managed to let it get to this state of affairs so close to the election, I just don't know. I think if Biden remains the Democrats' candidate, then Trump is very likely to win, because it's not going to get any easier between now and November, is it, for him? So I just think, and there'll be more scrutiny. So I just think if they carry on like this, like you say, they're all rallying around him and saying, no, he's the best person for the job. But if he is, then, despite what you say about, the economy not doing badly and all the rest of it, you would think that Trump would be the favorite to win. Whether they've got time to find someone else, and you kind of got, Kamala Harris, in theory, as vice president, should be the first in line, and maybe she's not so popular, so they'd have to find someone else, and there'd be a lot of, horse trading and infighting before you come up with a candidate. And it wouldn't be great, but as far as I'm concerned, if they carry on as they are, then Trump is going to win. But if they had a decent candidate, he's beatable because of all these issues he's had. And as you say, the US economy is doing pretty well. So it seems to me a terrible state of affairs when we've got everything going on in France as well, that the US Democratic Party have let it get to this state of affairs. But that's where we are.
Yeah, I'd agree. It's quite difficult to see. And just sticking with the US for the time being, we had the US central bank's preferred measure of inflation out on Friday. So both the headline and core PCE coming in at 2.6% on the year, which is good news as far as rate cuts are concerned, etc. So what did you make of the release, and what was the reaction in the bond market on Friday?
Yeah, there wasn't much reaction. The numbers are encouraging because it's the Fed's preferred measure, and as you say, and it's heading in the right direction, and corroborates some of the other data, which is definitely pointing towards rate cuts. Although job market's still pretty strong. We'll get non-farm payrolls this week, so they'll be quite important. But certainly, heading in the direction of rate cuts potentially in a couple of months or so. Bond market wise, the reaction initially fairly muted because the numbers were miles from expectations, but then we did see quite a big quarter end sell off. Sometimes you do get these unexplainable, bizarre moves, at quarter end, people rebalancing portfolios. But I wouldn't be surprised if there was some sort of Trump thing going on there, because Treasury markets are a little bit worried about Trump getting in, tax cuts and all the rest of it. It was already quite a big deficit. So bond markets have shifted a little bit away from thinking about the data, certainly for a week or two, and focusing on the politics at the moment.
Yeah, and sticking to the focus on politics, so back to France. I think Macron baffled quite a lot of people when he called the election, but potentially it's quite a clever thing to do ahead of elections later on down the line. Probably give the RN a bit of time in power, show themselves up potentially, and next election round it might be better. So can you give us a sense of what's happened in French markets, bonds, spreads over other government debt in the euro area? And is the bond market slightly concerned as to what an RN-led government might do or mean for markets?
Yeah, I mean, bond markets, particularly French bond markets, are concerned about it. I mean, like you say, the results of the election, yes, the Republic, the RN did win the first round, but it doesn't look necessarily likely they'll get that majority. So that's a bit of a relief. I mean, we have seen the thing that people are really focusing on, not just the performance of French stock markets and the banks, but also the spread of French 10-year government bonds over Germany, and that's been widening up running into the election. But this morning, so far today, that's sort of narrowed a little bit. So that suggests markets are a bit more optimistic that the RN won't win a majority. The two main concerns, and here we are, sort of 4 weeks after he called the election, and things have changed pretty rapidly. But the main one of the main concerns is the RN wants to spend lots of money, cut taxes and borrow lots, and that risks a sort of Liz Truss style sell-off in French government bond markets, which would be a concern. And the other thing is relationships with the EU, which after all have a lot of power over what goes on with the economy. That could become quite fractious, and that could, very early days, but repeat a little bit all those dreadful things that happened through the Eurozone crisis of a few years ago. So bond markets are concerned, but a minority government and sort of gridlock with Macron still as president might not be the worst thing in the world.
Yeah, I think I probably agree, Richard. Thank you for those thoughts. Turning to you now, Will, thanks for joining us. Firstly, if we just stick with what we were just discussing with Richard and the impact of the French election maybe on your sector. So what's been the impact for maybe European banks, particularly the domestic French names, BNP Paribas? Are there any signs of stress in the banking sector as a result?
Yeah, morning. I think those statements that we've seen from the far left coalition and Macron sort of announcing they'll not run as third candidates in areas where they think Le Pen will win mean it's likely that we get this hung parliament, a bit of stasis, and reduces the risks of the budget crisis that we saw in the UK, as Richard mentioned. We've seen a bit of relief today in terms of French stocks, including the banks in the context of this. So in terms of signs of stress, I mean, the market has been looking at the spread of French government bonds relative to German, as Richard mentioned, and then more specifically for the banks, looking at CDS spreads and also AT1 spreads. So these are kind of funding spreads for banks as a measure of credit risk. Both did pick up recently on the back of the political uncertainty, but they're still well below the level seen around the time of Credit Suisse's failure, for example, and nothing like the Eurozone crisis. So just to put it into context, and as Richard mentioned, they're kind of moving in the right direction again this morning. While the French and the French banks and French stocks generally have been in the market's sort of crosshairs at the moment, it is worth noting as well that the French banks, and we look at BNP in particular, for example, they're very diversified. So only about a quarter of revenues for BNP coming from France, for example. It does help them smooth earnings through the cycle. I think it is all, really about the fiscal concerns rather than anything sort of specific to direct impact for the French banks. There's been talk of maybe French banking taxes, for example, but the French banks actually haven't done as well from the rate hiking cycle as other European banks, just because there's already a lot of regulation about how much banks can charge on interest rates, for example. So you've not seen that higher profitability that you've seen in other markets. Some better news today, I think.
That's really helpful, Will. And then maybe just sticking with signs of stress. So last week, the Fed released the annual stress test results for banks in the US, essentially assessing the solvency of the US banking system. All 31 of the large banks passed. Could you just give us a flavour of the various scenarios that the Fed places the system under, who came out well and perhaps who didn't fare as well?
Yep. By way of context, stress testing came in post the financial crisis. So it's really a way of preventing the credit crunch that we saw at that time. So banks effectively stopped lending to protect their balance sheets, and that really worsened the recession. So the Fed now, places this stress on the largest banks in the US in the context of a very sharp recession. So, for example, unemployment up to 10%, a 55% decline in equity markets, and around a 40% decline in residential and commercial real estate. And then the investment banks also face the failure of their largest counterparty. So a really tough scenario for the banks to have to navigate. I mean, the punchline is that they all passed and they're able to absorb 685 billion of losses while continuing to lend to household and businesses, the real economy. Some will remain, pretty skeptical about the whole exercise, but the stress tests are actually quite important in terms of helping determine the minimum capital requirements for banks. So one way the market looks at this is the drawdown on capital that each of the banks see in the stress tests. So that's effectively the reduction in the capital ratio from the end of last year to the peak of the stress, and it's a factor in setting those capital requirements. So it's quite important in terms of for the banks and their capital plans. It doesn't tend to be a big driver for stock prices, and we saw that last week as well. In terms of the winners, actually, Citi seemed to do a bit better than others. It was the only bank that saw, of the very largest banks, I should say, that saw their capital requirements actually come down slightly. So all things equal, should free up more capital for dividends and buybacks. But then you saw on Friday when the big banks announced their dividend increases, you saw Citi only increase their dividend by 6%, and you saw bigger increases at the likes of Bank of America up 8% and JP Morgan up 9%. So Citi is still struggling a little bit in terms of the restructuring it's going through, so that weighs on profitability, and you're seeing higher profitability at Bank of America and JP Morgan, for example. So just to put that into context.
Yeah, again, really helpful, Will. And then just sticking with on the regulatory side of things, Basel III Endgame, which does sound quite ominous. For those of us less familiar with the proposed legislation, can you give us an overview of what it is, how it's developed maybe over the last year, and what we can expect going forwards? And I think maybe the US election might have a bit of an impact depending on who's in power.
Yeah, I think, remember that bank capital, all things equal, is a cushion or buffer that prevents a bank from insolvency. So if you have more capital, it should be less risk for the system. And the banks have seen a big increase in capital requirements post the financial crisis. And then, we've had this Basel III Endgame going on in the background. It does get quite technical, so I won't bore you with the details, but effectively it does mean another increase in capital requirements for banks. Regulators originally thought when this was first proposed that you would see about a 16% increase in capital requirements for banks, and then even larger increases for the biggest banks, the globally systemic banks. One way, for example, is giving banks less discretion to use their own models when they're setting risk weights on their assets, just to put it into context. But It does seem that the banks have been pretty successful in lobbying against these proposals, and the latest I've seen is that there will be about a 5% increase in capital requirements for banks, which is obviously a lot more manageable for the banks. It is likely, I still think, that we'll get this landing before the next US president comes into office, but I suppose there's always a tail risk that it is pushed out. It's worth noting, I suppose, that the US banks did seem to respond quite positively on at the end of last week on the increased likelihood of Trump winning following the debates. There's always the prospect of deregulation, I suppose, at the margin. And also, you saw a little bit of a steepening of yield curves as well. So when Trump won first time around, the banks actually performed quite strongly through that period. So yield steepening, all things equal, is quite positive for banks. So banks borrow short and lend long, so higher long-term rates is a positive for banks.
Yeah, that's really helpful. Thanks, Will. And then I've just got one final question for the both of you. Now, I know there've probably been enough headlines around betting on elections, and I'm not suggesting either you do put money on it, but perhaps predictions for the general election, winning party, and your best guess at a seat majority. Richard, starting with you.
Well, surprisingly, I think Labour will win the election. That would be a big shot. But the polls obviously suggest they're going to win by an absolute mile. I mean, I think when we get close to polling day, maybe the Tories vote will pick up a little bit, and maybe there's a bit of Euro 24, good feeling factor, or rest of it. I think it'll be something like around 150 seat majority. So still massive, but maybe enough to make sure the Tories, remain the sort of second party.
And then Will.
Well, it's just 150 was going to be my number, but I will have to choose a different number on the back of that. So I'll go slightly higher and look at 170 Labour majority for me, please.
That's great. I'll go even better than that. Let's say 180, and then I guess we can reconvene next time around and see who was closest. So thanks both for your insights, and to all of you for listening. So did you enjoy our discussion on the podcast today? We'd love to hear from our listeners. So please review the show now wherever you're listening, and share it on your socials, and tag us at Quiltachievate. To make sure you don't miss a future episode, tap the subscribe button. We'll be back next week. In the meantime, head over to our website, www.quiltachievate.com, where you can read the accompanying market overview, as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on markets, news, industry insights, and any upcoming events and webinars on our website or on our social media pages. And then finally, if you have any questions you'd like to ask one of our experts for our next podcast, simply ask them via the weekly comments page on our website. We'd love to hear from you. And that's it for today. So thank you to Richard and to Will for your time, and to all of you for listening. See you next time.